Good afternoon, everyone. Glad to see a full group of people for our meeting this afternoon. I believe this afternoon's meeting is basically more on the informative side. I don't believe we have any action items predetermined, so we have a series of presentations that some are routine and some are new and special. So I think that's basically what comprises our program for this afternoon. So I think we can go ahead and get started. We can open up with the opening statement, please.
All right. This is a regular meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you. Sherry, would you please take the roll?
Yes, sir. Dr. Hackbart?
Here.
Mr. Cheatham?
Here.
Mr. Fulkerson?
Here.
Mr. McGraw?
Here.
And Mr. O'Mara?
Here.
Thank you.
Thank you, Sherry. Also, Sherry, I believe there was one public comment?
Yes, sir. We received one public comment for this committee meeting, and I will read it, and it is as follows. This is from a Mary Sheila Harper, and she writes, Board members, please support the House Bill 406 and implement the additional pension check for CERS retirees. Thank you.
We appreciate her comment and will respond accordingly. The next item is the approval of the minutes of the November 25th meeting. I assume everyone's had a chance to review those, and if so, would someone please move to accept the minutes as presented?
So moved.
So moved.
Thank you. Second?
Second.
I have a motion to approve this and a second to approve the minutes as presented for the November 25th, 2025 meeting. All those in favor, please indicate by saying aye.
Aye.
Opposed? Motion's approved. The first item of activity and business this afternoon is an update on the CERS Cost Efficiency Services RFP. And I guess the update will be by, I'm not sure who from the investment staff, but whoever is going to present that, please take over.
Sure, it's me. Thanks, everybody.
Oh, thank you.
Just gonna,
Yes.
how are you doing? Yeah, we are, just a quick update. I think that this RFP was approved, a motion for that last June, and the RFP was issued last summer. And I think the update is that we're finalizing the candidate pool and a recommendation for validation of investment fees and expenses for private markets in accordance with the terms of the revised CERS investment procurement policy that was recently approved. So, and so we're happy to take any questions, but that's where we are with that right now.
Any questions of Anthony?
Yes, Mr. Chair, if I might.
Do you have a timeline to complete your finalization?
Yes, I think we'll have something ready for the next board meeting, which is March the 9th, I believe, for you all.
Okay.
Good. Any other questions or clarifications of the schedule or the process itself? If not, thank you, Anthony. Appreciate your work on the regard to make an adjustment and accordingly.
Sure.
Next item of business is the private equity pricing strategy, and I believe that presentation is by Ed and by Wilshire staff.
Thank you, Mr. Chair. I had asked to introduce this segment because I wanted the committee to be aware of conversations, Mr. Chair, that you and I have had going back almost a year, that we wanted to energize, invigorate the conversation and the debate at the investment committee. And we thought that one of the ways that we might be able to do that was to, Wilshire has provided the capital market report that they normally provide, and anyone that has questions concerning that information, feel free to ask them, and they will give you detailed answers on it. But the chair and I determined that for the 4 meetings that we would have over the course of a calendar year, that we would take 2 of those meetings with Wilshire and allow them to present to us very specific market-driven information that could be actionable for us. Something that was topical in the news, something that we needed to be aware of given the ever-changing landscape of this marketplace. We opted for the first time to follow up on what had been presented by Wilshire at the trustee forum, so that we could fully flesh out what it would look like for us to engage with a pacing strategy specifically for private equity. So we asked Wilshire to put that together for us. They've done that. And David, with that, I'll turn it over to you and your team.
Great, thanks. Yep, so a lot of this, if you were here for the forum, you had a chance to see this. In fact, John Patterson, who will lead this presentation today, led us through this at the forum. But just to back up a minute, the pacing analysis, it's a very important analysis, and it helps you to maintain your target allocation, or wherever you want to be in terms of the private equity allocation. It helps to maintain that. If you think about that part of the portfolio, it's slower moving, there are capital calls, there are drawdowns. It's not just like rebalancing something in the public markets where you can set it to target and continue to just rebalance that. So it takes a lot of looking forward to model how to get that private equity where you want it to be and how to maintain it as funds come out of it year over year. So that's what this pacing analysis does. We continue to revisit this. It's not something that's a perfect science. Things can shift it around quite a bit. In fact, when we have big market movements, either positive or negative, what we call the denominator value, which is your total fund asset value, that can shift a lot, which could, make you overweight or underweight private equity. Those have gone kind of both directions over the past decade for most institutional asset owners. So taking all that into account and, just being aware of that, it's a great modeling process. And the outcomes are that it does help keep portfolios pretty much in line with where they're trying to be. And it keeps you focused on not missing out on vintage year exposure, because every year is a new vintage year in the private markets, and what 2026 will look like in terms of a vintage year, we don't know for a long time yet. So it's important to diversify and be allocated across vintage years over time. So this takes that into account as well as then the structure we'll present today, just how we think about the structure and what our views are in terms of a current allocation within private equity portfolios. So John will take us through this, and feel free to ask questions as we go. And
Can I start?
yep, sure.
Okay, let me make sure I'm understanding terminology. So pacing and vintage year,
Yes.
is that like laddering bonds?
No, so pacing is just the pace at which you want to make commitments for new investments year over year in private equity. That's the pacing component of it. And the vintage year issue is just every calendar year is a new vintage year, kind of like wine, in private markets. And that it takes a long time to know how well a particular year will turn out in private markets.
And think of pacing also as well as when you have a mature private equity portfolio, you're receiving distributions from commitments you made several years ago. At the same time, let's just say you make $500 million worth of commitments in a given year. That all doesn't go to work right away. The partners that you're working with are going to call that capital down at different rates of time. So the work that John has done has various assumptions that go into that, how quickly that'll get called down, and how much distribution you're going to be receiving from your current portfolio as well. So it's a constantly evolving piece of the portfolio. As David said, it's not just like saying we're going to put X amount of dollars into public equity and it gets to work right away. You're making these investments, it gets called down by the GPs that you're partnering with, and that's an evolution that keeps going on.
Appreciate it.
So this would be a continuous review relative to our asset allocation recommendation or policy for private equity. Is that correct? As some would presumably roll off after 10 years and so forth, to kind of give us a better idea of where we are in terms of our meeting with and complying with our asset allocation policy.
It's something that we revisit on an annual basis. Typically, quarter to quarter, your pacing the numbers aren't going to move enough to really make a difference. But it would be reviewed on an annual basis to make sure you're not getting too far above or below your asset allocation targets to private equity.
Would this also focus on what's happening in the general private equity market?
Yeah, absolutely. So the model that we use, we can change we call it the waterfall of distribution. So it's basically how much cash is getting given back to you versus how much you're sending out to private equity GPs. And so if the market is really slow and we're not seeing a lot of M&A transactions like we saw for the last 2 or 3 years, we would slow the distributions in our model and say, hey, our model doesn't look like the market right now. We need to change things up and make sure that it actually mirrors what we're seeing in the market right now. So the model absolutely incorporates what you're seeing in the private equity market.
Would this also focus on the differential between the public and private equity markets in terms, I think there have been some articles indicating that there's been a narrowing of that differential. Would that be part of this as well?
So our model is really taking into account private market returns. We're not really, we're focused on the private market side of the portfolio. I would say that, to your point, there has been some headlines around private equity not outperforming public equity. I think that there has been a substantial run-up in the public markets for sure that has made private equity, it's been tougher. It's been a tougher bogey to beat. That said, first quartile managers, which is what we're shooting for in a private equity portfolio, getting you in the best in class managers in private equity, they are beating public markets equivalents, consistently over time historically.
Yeah, I'll add to that, John. I think when you think about the differential between public and private, from a forward-looking perspective, when we develop capital markets expectations, in fact, their page of those data are in your book here today. Looking forward, we in fact have a smaller gap expected between public and private markets right now, looking forward. But that is sort of effectively thinking about private equity as a very broad group, and if you could index it, it's sort of it's not the focus on the top quartile managers, which is where you want to be. So it's more of an asset allocation beta focus. So that varies. Sometimes that's 3% or more of a differential. Sometimes it's 2.5%. But implementation has a ton to do with how your results work out.
If I could, Mr. Chair, I tell you, I think this is exactly, Mr. Chair, what we envisioned. Even before we've gotten off the first page, we've had a good dialogue and several questions. And John, I'd like to ask one more. As you guys know, we have a legacy private equity portfolio of about $110 million or so. You indicated that the last 2 or 3 years there haven't been much M&A activity. What do you perceive happening, or do you have an opinion of what might happen over the next 2 or 3 years? And then how would that inform what we should do with that legacy private equity?
Yeah, so M&A's been slow, which means that the portfolio companies in your portfolio have not been sold. And so you're not getting money back from those portfolio companies. Our expectation and our hope is that M&A is going to open up a little bit over the next 18 months so that we'll start to see more distributions across the board in private equity, that assets that are longer in the tooth that private equity managers have been holding on to for too long. It basically becomes a point where they have to sell them. They need to get distributions back to their investors, or else they can't raise their next fund, or they essentially need to get these assets sold. So we feel that there's a backlog right now of M&A built up in the market that hopefully will start to alleviate in the next 16 to 18 months. And so we'll start to see more distributions from your legacy portfolio. That is our hope. I'm not saying that that entire portfolio is going to get liquidated at once, and it's tough to make a call on exactly how much of it is going to come back, but that would be our expectation.
It seems like we've had more continuations in this area over the last year. I'm not sure if it's about the same as prior years, or is it peaking, or is there an unusual situation why we're having a number of continuations of private equity investments?
Yeah, continuation vehicles, I think I saw a stat that in 2025, continuation vehicles were 20 to 25% of the exit market in private equity, which is up from 4 or 5% 5 years ago. So you're exactly right. Continuation vehicles are becoming a part of the market. I don't think it's going to go away. It might only get bigger. Specifically as we see the backlog of deals I mentioned, and then also a capital overhang where there's still a lot of dry powder in the market that needs to get put to work. So yeah, totally agree. CVs have become a big part of the market and probably will continue.
Is there a reason for that? Why that's occurring that way, going from 5% to 20 or 25%?
Yeah, I think there's a number of reasons. I think one of the biggest reasons is there's a mismatch between buyer and seller expectations. You have sellers that are wanting to sell at 2021 multiples, and you have buyers that are not willing to pay 2021 multiples. And so the regular way exit that we used to see in private equity, where you buy and sell to either a strategic or another private equity sponsor, that's become less able to happen. And so CVs become a nice way for private equity sponsors to basically get liquidity for their investors, but still maintain a hold on the assets so that they can wait for a regular way exit in the future.
Any other questions before you want to proceed with your presentation?
Yeah, John, or Chris, whoever wants to address it, I think it would be helpful for everybody to understand when we're talking about our asset allocation. I think you touched on it a minute ago, that when we say, private equity is targeted at 7%, let's say, that is that takes into every type of asset class within private equity, correct?
All the different
Could you-
styles.
Exactly, buyout, venture, special citizen distressed, yes.
But not private credit and real assets.
Correct.
Right.
Equity.
With that in mind, and in conjunction with what you're talking about as far as targeting, the top quartile managers or, asset classes within private equity, can you just kind of touch on what some of those are? I mean, as far as the types of assets that or industries that we're talking about. I think that would be helpful for everybody, particularly in comparison to, what might have been a really good target industry class 10 years ago may not be the class that we need to be setting in right now.
Sure.
Yeah, and I think that links into what you're talking about and alluding to with your vintage years.
Yeah. So we have a slide in here on kind of how we would recommend constructing the portfolio, but to your point, there are times to be tactical on the margins. And, I would say as a general rule of thumb, Wilshire has a focus on investment managers that are at the lower end of the middle market, that are that are investing in parts of the market that are just inherently less competitive. And so pricing is typically lower. And so you're able to get assets for cheaper, you're able to grow those assets, and you're able to sell them upstream to those middle market and upper middle market private equity managers that have a massive amount of dry powder that they need to deploy. So we tend to focus on the smaller end of the market, which is one area we focus on. We also tend to focus on groups that have some sort of sector specialization or have operational expertise. And what that means is, from an operational expertise perspective, they have people on their team who have actually owned and ran a business before. They're not just financial investors. They have ex-CEOs or ex-managing directors from a supply chain company or a manufacturing company or a government tech company, whatever the case may be. They have real world expertise on how to operate those businesses. We think that adds a significant amount of value outside of what typical private equity groups that just have a financial understanding of the business can do. And then the last thing I mentioned was sector specialization. We believe that there's no replacement for sector specialization, specifically in certain industries like healthcare, where you need to have a deep understanding of the regulatory environment, stroke of the pen risk, the different ways that different healthcare companies are reimbursed. It takes a massive amount of knowledge that generalist private equity firms just don't have. In other areas like government services or aerospace and defense, you need to have the relationships in Washington, D.C. and the networks to really be able to find the right investments and then make sure that they have the right contracts. So I gave you a lot of examples there, but that's kind of the flavor of the types of investments that we focus on. And we can toggle in and out of certain industries when they come into favor and move away from other industries when they are more out of favor. So as an example, right now, we're very focused on aerospace and defense, a lot of tailwinds behind it. It's a space we're heavily focused on, a little more cautious in tech right now, just given everything that's going on in software, the AI disruption that's happening. And so, we're not making as many investments there, but I could go into a lot more detail. I'd love to talk about it, but hopefully that gives you a flavor.
That was helpful. Thank you.
Yep.
John, one more question before you start. You mentioned that the Wilshire focus is on the manager at the lower end of the spectrum. So what does that do? Your focus there, does that play into risk? does that play into leverage? How does a focus there impact the investment?
Yeah, I think there's a common thought that, you know, smaller businesses mean higher levels of risk. And that's just given, you know, much more scaled businesses are you know, easy. They're just a proven entity. I think at the lower end of the middle market, what goes unlooked is that at the lower end of the middle market, these businesses inherently cannot take on more leverage. They don't have the access to the debt capital markets that other middle market and upper middle market businesses have. So they're not going to have much leverage on the businesses. The businesses that we typically look at are kind of sub 4 times leverage. In the middle market and upper middle market, you're looking at sometimes up to 7 and 8 times leverage. So that incorporates an element of risk in the middle market that you don't see at the lower end of the middle market. There's other elements as well. With smaller businesses, they're easier to move, to pivot, they're more nimble. So if one of those businesses does get in trouble, it's easier for an operationally focused manager to pivot those businesses to make the operational change needed to get them headed on the right path. And with bigger businesses with, you know, hundreds of thousands of employees, it's a much more difficult movement to make when a business gets in trouble, to be nimble, to shift in the direction you need to go.
Let me follow up on one. So I guess coming from the credit markets, to me, when I hear they don't have access to the traditional credit markets, so there's probably a reason for that, right? So isn't that an indication of risk? If you can't get debt finance, then you go to private equity. Isn't it the opposite?
So I said the same level. So essentially, they still have access to credit. I don't think, and there's very few equity-only deals that we would see, and those would probably be in, more to your point, stressed or distressed situations. The availability of debt is just lower in the lower middle market because, you know, these are smaller businesses inherently. They don't have the scale of a much larger business, so they typically are only levering it, you know, 3 to 4 times earnings. Because, you know, number one, they're not accessing large syndicated loans. They're not accessing, you know, large national banks. They're not leveraging those large capital markets institutions. They're typically going to regional banks. They're typically going to private credit lenders, and there's just inherently less appetite to give out debt.
But isn't that correlated to risk?
I would say, yeah, I would give you that point. That from a credit perspective, I'll say one thing. Larger institutions, smaller businesses aren't going to move the needle for them. So they're not willing to come in and lend 6 times to a small business because it's just not going to move the needle for them. They're writing a check for $30 million when their, you know, typical check that they're writing is $150 to $200 million. So it's not going to move the needle for them. So you have these smaller institutions that are a little bit more cognizant of how much they can lend out. So they're, you know, sub 4 times is typically what we're seeing in the lower middle market. I would say, I would give you kind of half your point where, yeah, I think there is an element of perceived risk there for small businesses.
And I understand the size argument, right? If it's not a large enough block, or
Yeah.
Okay.
Yeah.
So smaller companies, from one perspective, could be higher risk, all other things being equal.
Sure.
But from another perspective, they're not going to have as much leverage on them as
Are the
many of the bigger.
are the continuations more common in the lower market?
I think it's probably more in this. I would need to look at the numbers specifically, but I think it's probably more in the middle market, pure middle market space. We have seen a few CVs from our kind of lower middle market managers, but I think the majority is in the middle market and upper middle market. And to be honest, I think that has a lot to do with the fact that in 2021 and 2022, middle market managers paid a little too much for their businesses.
So the point of, you know, of a lot of what you'll see today is how to think about what you need to make in the way of commitments year by year in order to get your portfolio near its allocation target. John will walk us through some data on that in a few slides.
And maybe just one last thing to clarify. So, you know, we do like the lower end of the middle market. That's not saying we're completely hands off. in the middle market. I mentioned the aerospace and defense space. That when you have a niche, oftentimes you can add value regardless of what part of the market you're in, and oftentimes you have a competitive advantage regardless of what part of the market you're in. So we do look at, not only the lower middle market, but middle market specialists as well. So I just want to make that clarification. Great. Well, I'll jump into page 12 if there's no other questions. And we touched on a lot of this at the forum, so I don't want to belabor the point here. But I think everyone's aware of the benefits of private equity. From a efficient frontier perspective, it leads to incorporating private equity leads to enhanced risk-adjusted return. Increased diversification. I think this is one that's a little bit overlooked from time to time. When you think about the Wilshire 5000 index, I think there's roughly 3,500 companies in that index. And a lot of studies have shown that in the private markets in the U.S., there's over 25 million businesses in the private markets. And so getting exposure to those private businesses that are a large part of the U.S. economy is important to diversifying your portfolio. And so increased diversification is another benefit. Premium returns, we mentioned it off the top. We still believe in the premium returns in the private equity space as long as you're picking the right managers. And then finally, lower volatility. Lower volatility is inherent to private equity just given the way it's marked. It's not marked like public markets investments where it can get whipsawed based on public sentiment. In the private markets, it's held on a quarterly lag. Typically these investments are, if there's a massive movement in the markets, they're marked down over time as they've seen degradation in their portfolio companies, but they're not subject to the massive whipsaws that you see in the public equity markets. So just inherent to the space is a lower volatility.
And John, just one clarification on there. If anybody's thinking, strategic asset allocation, if you have lower risk and higher return, why wouldn't that be a more preferable asset class than, say, public equities? What you're really talking about is the path of returns there,
Exactly.
right? You're not going to see the markups and the markdowns like you would in the public equity markets if you're in a volatile market. The true economic risk within private equity is higher than public equities. So we talked about leverage. When we look at our private equity modeling for you, compared to public equities, there's probably about a 40% increase in the quote-unquote risk level from that perspective. So I just want to differentiate between an accounting risk and an economic risk
Good point.
between the two.
Good point. I'll add just one more comment for context on all of this is about private equity, and your strategic allocation target to private equity is 8%. So that's already part of your asset allocation, strategic asset allocation, and so we're just kind of stepping down in talking about that, and then how do you keep that invested?
And then the middle pillar here, critical elements of a private equity portfolio. David touched on it. Consistent pacing is crucial to a successful private equity portfolio. Not missing out on a good vintage year, not being overexposed to a bad vintage year, extremely important. And then also, from an asset allocation perspective, it's extremely difficult to turn on and turn off a private equity allocation to bring yourself back up to target when you fall below it. So you need to really have a disciplined pacing approach so that you can hit your target and not fall below or overshoot it. Manager selection in your portfolio is going to be critical. The private markets have the largest dispersion in returns between top quartile and bottom quartile managers than in any other asset class. And so picking top quartile managers is extremely important to a successful private equity program. And then diversification, not only by vintage year, but by sector, buyout, venture capital, distressed debt, and special situations, as well as by geography. So not just having exposure to the US private markets, but also to Europe and to Asia. And then finally, this is one that I wanted to bring up, specifically because sometimes we look at the implementation of a private equity program and we see all the benefits, but there's also a lot of, work behind the scenes that needs to be done to have an efficient governance process to make private equity commitments. So, private equity is different than other asset classes in that these funds aren't always raising capital. They will raise capital for a short period of time, and then they will close their fund, and they will go invest your capital for you. And so being able to source investments on our part, being able to execute those investments, and being able to approve those investments is something that you have to be cognizant of. You know, we're looking at between 8 and 12 investments a year in private equity. And so that would mean opining on, 2 to 4 private equity investments a quarter, basically, on average. And so that's something that you need to be eyes wide open on as you think about implementing a private equity program. And then in this last pillar here, considerations for the CERS program. We talked about disciplined portfolio management that covers pacing and diversification. The second bullet here, accessing Wilshire's research. It's not just me on the private markets team. We have a team of 40 individuals across 3 continents. We work closely together. We have every Monday investment committee meeting that we go over our investment opportunities. We have 3 offices in the US. We have an Amsterdam office in Europe that handles the research on all of our European investments. And then we have an office in Hong Kong that handles the research on all of our Asia Pacific investments. And having boots on the ground in those locations, it's pivotal. It's extremely difficult to not only find the managers, but to diligence them unless you have boots on the ground. And so, we have probably 80 research reports that we do a year across the private markets. And so we're happy to share and to be a partner with you all, and you have access to that research, and we hope that you will leverage it. And then the last 2 bullets I'll kind of take in tandem, streamlining your process and managing resources. I touched on the efficient governance. This is there's a heavy lift involved to running a private equity program. So understanding your investment process, not just the sourcing and diligence and approval of the private equity program and the private equity investments, but also, once approved, there's legal, there's sub-documents that need to be filled out. It's a intense process. And so just making sure that we have command of a streamlined process, and also, we would love to partner with you on kind of managing those resources, managing the process in whatever ways we can. So just understanding that division of resources would be great. So that's all I had for slide 12. I talked really fast there. I was trying to catch up a little bit. But any questions on slide 12?
Not really questions, John, but if you, 2 things you mentioned. One was, you'd like to see between 8 and 12 investments made per year. How is that compared to the number we have been doing per year? And the second part of that, and I think it might be advantageous for everybody to understand or hear, most of these private equity investments, as you talk about the distributions, a lot of times we're talking about what, we're making these investments, and they're making big distributions out there in some cases that have to find a place to go. And to what extent that is part of this, 8 to 12 investments that we need to make, and what you think the average size of those investments ought to be in comparison to what we're doing now.
Sure.
So those are your 3 loaded questions.
So maybe I'll tackle the last one first. So in a perfect world, your private equity program would be what we call self-funding. So to your point, as cash is being distributed from your older managers, your newer managers would then be making investments and calling capital. And so that capital would stay within your private equity program and essentially we'll call it recycled. It's not a perfect definition, but it would fund itself. So a mature private equity program, that's how we would expect it to work after 5 to 6 years of investing. We would hope that distributions at that point would start to outpace your capital calls and would fund your private equity program. From a pacing perspective, we have some slides in here. Maybe would it be helpful to just jump down to the pacing and
go ahead.
Yep. So jumping down to page 14, I believe. Oh no, sorry. Yeah, let's go to page 15. So if you look at the top right chart, that's the commitment and fund pacing. This was as of, and maybe just off the top, all of our materials in here are as of June 30 of last year. The reason for that is, as I mentioned, there's a bit of a delay on reporting in private markets. We didn't have the 12/31 numbers yet, so we just decided to move forward with this. So if you see kind of what looks like stale numbers, that's why. But as you can see here, commitment pacing has been light for the past 5 years. There was a commitment back half of the year to strategic value partners in the distressed debt special situation space. High quality group, a group we know well. We're invested in SVP as well. But that was a commitment made in 2025 that's not reflected here. But to your point, Lyle, I think, part of the reason why I wanted to upfront mention that, it's a heavy lift really operating a successful portfolio is because it would be a significant uptick in private equity investments that would be made on an annual basis. We mapped out 9 investments per year in our construction. To be honest with you, we were a little more concentrated than we typically would, and that was just, to make sure that we weren't, being a little bit too stressful and recommending 12 commitments or 14 commitments, which would, be a little bit more diversified, but would also be a much heavier lift for you all as well. So I would say that it'll definitely be an uptick in private equity commitments on an annual basis. Does that answer your question?
Yeah.
Okay.
Size.
Oh, size of commitment. Yeah. So, would it be all right if I walked from pacing through construction and then we'll show the size of the
It'll start to answer that question.
Yeah, it'll start to answer those questions. So let's just jump down to slide 17, or page 17, excuse me. So this is our private equity pacing. We have a proprietary model that we use. I mentioned it takes into account, a waterfall of cash flows. We have the ability to take into account current market environment and to make that waterfall slow or speed up to make returns get smaller or grow depending on the market environment that we're in. And so our model right now is taking into account that you have a pretty solid backlog of we call it more dated investments, and we would expect that hopefully some of those investments will come back to you in the next 2 years. And so, as you can see, we're starting out at an allocation of roughly 5.5% to private equity right now, about 2.5% to 3% below your target allocation. We expect that to continue to dip as your legacy investments are realized, potentially even hitting kind of 5% underweight in kind of 2026, 2027 time, or excuse me, 2027, 2028 timeframe. And so, our proposal is that, you start making more frequent private equity commitments to make sure that you don't fall too far below your asset allocation targets, because it does take a long time to get back towards target. As you can see here, we build out our model based on your current planned NAV, your current private equity net asset value, that over the next, we run them for 10 years, but over the next 4 years specifically, commitments of $600 million per year for the next 2 years. And that is due to trying to ramp you a little bit back up towards target quicker. And then stepping down to $500 million in 2027, in 2028, and then $400 million thereafter. And so that is our pacing plan. As you can see here on the graph on the left-hand side, it brings you up to your target allocation in roughly 2031 timeframe. And then there's a slight bit, less than 1% of overshoot, but then it moderates and comes back down towards target. And we believe that $400 million number will help keep us there in perpetuity. Again, we release this on an annual basis. And so, yes,
It seems to me that this is predicated on the assumption that we would maintain the same allocation to private equity, which I'm not sure about, given the conditions that are occurring and the trends that are occurring of private equity versus public equity and our other assets in our portfolio.
Sure.
So I guess I find it a little bit I'm not sure the pacing is really the issue. The question that we always can deal with is whether or not our allocation, overall allocation, but this, if I understand correctly, this assumes that we're assuming we want to maintain the same percentage allocation to this particular asset of our total portfolio, which it seems to me is something we continually review. So I'm not sure pacing then fits.
And
that is
accurate. We generally review your asset allocation on a 3-year rolling basis. So during the last asset allocation review, you did approve a target policy of 8%, and we will review that again, likely in the next 18 months or so, 12 to 18 months, we'll start another asset allocation policy that will be reviewed. That information would get fed into the model, so if there are changes to your policy, your commitments would change accordingly as well.
Right. So in other words, if the differential between private equity and public equity is narrowing, that would bring into question whether or not we want to continue to have, for example, an 8% commitment. And because in effect, we have liquidity issues and so forth and continuation issues with private equity, which has been a continuous concern of ours, I think.
Well, yeah, so I'll just add, so, I mean, that's sort of a bigger question as we go through the asset allocation work. Each time we revisit that, we do a lot of things, even in that modeling, to project your liquidity over time. And so it is a decision you have to make each time that we do that. Is 8% private equity the right amount? Should it be larger? Should it be smaller? And the pacing is designed to help you maintain whatever that target is. Yes, that target can change, but you'd still always want to be doing pacing so you can try to keep that program on course and diversified, well diversified across vintage years.
And I, to your question on kind of the, I guess, premium over public markets, if we could turn just quickly to page 25. I think this graph on the left-hand side on page 25 is a really good indicator of, while yes, the spread between public markets and private markets has gotten a little bit compressed over the last, call it 2 to 3 years due to the run-up in the private market or the public markets. We still see that private equity is outpacing public markets over the long term. And I don't want to speak for the asset allocation itself, but when you're a long-term investor and have a long-term asset allocation, that's what we're thinking about. We're not thinking about blips in the public markets and whether or not right now the spread is compressed a bit. We're thinking about longer term, and we believe that it's proven that private equity over the long term has outperformed.
And to one of the points a little bit earlier that John mentioned, the diversification and the more infrequent marks of the asset class, if there is a dip in public equity, you're going to see that gap between the two even widen out a little bit more potentially there. So you are getting exposure to growth through both of these asset classes, but the insulation from the ups and downs of the market that's priced immediately is a little different there with the private equity exposure.
Right, and I'll just go ahead.
Just two quick questions. And I think it was on the previous slide, just so everybody catches it. Our target currently is 8%, but we're currently at what percent now? 5?
Yeah, a little over 5%.
Okay, but it looked like you had it, projected out that we would be what, 5% under allocated here in the next year or so.
Yeah,
I assume that it.
So
I assume that's from liquidations and distributions or what have you.
Yeah, Ed touched on a bit the legacy assets in the portfolio, and there are a number of them that are extremely long dated at this point. And so our model, it just wants to run them off immediately. But what we did is we went in and smoothed it out a bit so that those assets are left for a few years. We tried to take a little bit more of a direct approach And some of the more recent legacy investments that have the potential of being realized over the next 18 to 24 months if M&A markets open up a bit. We allowed those to run off over the next 2 years, but it's not a substantial. I mean, it's a decent amount, but not it's not half of your private equity portfolio getting realized today.
Yeah. The other part of to what extent in this pacing did you take into account the overall growth in the portfolio? I mean, we've seen, it'd be great if it continues to do it, but we've gone from what, 16 billion 2 years ago to almost 21 billion today.
Almost 22.
Okay, so, based on that, just, if all we wanted to do is maintain our percentage that we're even at right now, we're still going to have to come up with more money in places for it to go.
Yeah, that's a great point. So we started out with at your 630 NAV, over 20 billion. And then we layered on top of that a kind of expected nominal growth rate, which we feel is conservative, of roughly 2.5% per year. And so
that would be investment return on the total portfolio.
Total portfolio, exactly.
And then and adjusted for contributions coming in,
exactly,
and benefit payments going out. So when you put all that together, that's the 2.5%, which is synchronized with your actuarial data as well.
Exactly.
So thinking big picture, net of all that activity, the fund would still be expected to grow at about 2.5%. Yeah. So that's the denominator that we talked about.
So that incorporates, to your point.
I guess the point I'm trying to confirm is, and I understand Dr. Hackford's concern, or as far as, does that number need to be 8% or 5% or 3% or 10%? Just because of growth in the portfolio and the nature of the investments, we're going to continuously have to find places to go, whether it's for a 3% allocation or a 5% allocation or an 8% allocation. Is that fair to say?
Absolutely.
Okay.
Question.
Well, I'm sorry, I'm in the weeds. On slide 17, you say we're currently at 5%, but it says in 24 we were 5, in 24 we were 5%. It says for FY 2025 3, and for FY 22 6, it's 3, and then at 27 it's 4. Where's the current 5% on your on this slide?
Yeah, so apologies again, this is a bit of a product of this being stale. And this is kind of a side, but it also...
This is also in the weeds.
Yeah, this is also in the weeds. So running mid-year pacing can make the numbers, to your point, on the years look off, because, if we're basically proposing that in 6 months we have to make 600 million in commitments at this point. So what we typically do is run our pacing at 12/31. We wanted to have fresh numbers when we were at the offsite earlier, and we haven't yet gotten 12/31 numbers. So that's the reason why this looks a little bit off. But if you look at...
It would essentially shift the titles more than it would
It's exactly
the dollars.
It shifts the titles.
So the columns, Bill, 2020, December 24, and then year 25, year 26. We recognize year 25 is over.
Right.
But this is built out of June 30, and then it takes a lot of time to get all that data into it. So we typically rerun this 2 times a year if we were to build the portfolio.
Oh, okay, second question.
Yeah.
So I'm reading up above here that you start at 6, go to 5, and then step down to maintain 400 million thereafter. Is that assuming that it's self-funding at that point or not?
At the point where we step down to 400 million? So that 400 million step down doesn't really have to do with the self-funding nature. Yeah, it's basically the reason why. So if we were to just start out 400 million today, you would eventually get to your target. It would probably take 10 to 12 years to get to your target asset allocation. The way we paced it out today allows you with 600 million, then 500, then stepping down to 400. It actually brings you closer to your target allocation almost 5 years faster. So that's the reason for the step down in 600, 500, 400. 400 million in steady state will get you your target. It's just going to take a very long time.
But is,
My
if the
question is, when is
related
it
to
self-funded?
where's the cash coming
So-
from? Those numbers are how much you commit to every year. The source of the capital is not part of that. So it's not saying 400 million out of cash every year. When it becomes self-funding is really something else we could determine that's not shown here, but it's based on how quickly the
That
managers
wasn't
put it to work.
implied here.
Yeah, I can bring up the
Okay,
model.
that's what I'm asking.
Yeah.
I can bring up the model, but if I'm remembering correctly, it's probably around year 6. So 2032 becomes self-funding.
Well, an example, I think we can make a small example out of the bottom chart on this, which is we modeled on the far right side, there are 3 sections. The top is the current denominator value, and then the private equity program you have in place. Second section is the existing commitments. These are ones you've already made. And then the bottom section are future commitments. So I think if you go, correct me if I'm wrong, John, if you go to the final column on the right, year 2028, the bottom 2 lines, contributions that year. So with this pacing build of 600, 600, 500, 400, we're projecting out in 4 years, what will be your actual contributions that year? And we have this projected at 473 million. And then in that same year, from that same part of the portfolio are distributions of 192. So that starts to grow. And the point about self-funding takes a long time. But a lot of organizations, whether they're pension plans or foundations or endowments, if they've been in this a long time and they constantly pace and they try to stay there, they become self-funding.
I was just trying to understand what you were and weren't saying on this slide.
Okay.
That helped.
Yeah.
Yeah, as you can see, in basically the 3-year range, you're at roughly 500 million in contributions, so capital calls versus almost 300 million in distributions. So you're not there yet, but you're getting closer. So probably years 5 or 6.
So the ultimate question, I guess, that you're putting in front of us is, just like the legislature has told us to reach full funding by 2049, you're recommending to us that we get to full funding in our private equity exposure within 5 years, whether that is at 8% or 5% level. You know, it would automatically adjust for that decision, correct?
Yes.
Okay.
And the chart on the left on this page, just 2 simple lines. The bottom light blue line, it's an extreme. So it just shows your current program. If you do nothing, then you can get a sense of how fast it rolls off. So in that 4 or 5 years, if there are no commitments, you'll be potentially close to 0 in your private equity. Then the other line is obviously the graphing of everything we've built into the pacing model, where we try to get there. We try not to get there on too steep of a line so that it doesn't overshoot it, but then try to maintain over time.
Yeah.
Keeping in mind that you continue to revisit this because things do drive it.
That's a huge point, and I think maybe the first thing I should say, and probably should have let off with this, this is 50-50 art and science, and that's why we revisit every year to make sure that what we're projecting is actually coming close to what your actual outcome is. And so if we revisit this on an annual basis, we get a good idea of if our capital calls and distributions are kind of moving in the direction we expected them to. But again, there's, I think you're drilling in on it. There's some art to this. It's not just science.
That's why we say it's not perfect,
Yeah.
but we want to do it continually to tweak it as we go. All it takes is a year where there are no distributions, and maybe for that year we had expected 200 million in distributions. Now it's a changed.
Or a market event, your denominator, your total market value changes
Right.
substantially. That's going to have an impact on your allocation to private equity.
Yeah. But I made the point at the open, even though this is not a perfect science, we have, we see outcomes by approaching it like this. Generally speaking, you get pretty much to where you want to be. It helps you. If you had no pacing, you would sit back and think, well, how do I get to 8% in private equity? What do we put to work? Because we got to do that over time, and we make commitments, and then those commitments get drawn down over a number of years. At the same time, money's coming back. So, you really have to model this to think about at the highest level, what do we start with, how much money to put to work?
So your modeling is just putting together a mechanism and a process and a procedure to reach whatever our target allocation is.
That's correct.
Yep.
Lyle, you took the words out of my mouth, because I think that you made the very operative point here, that irrespective of whether the goal is 8% or 5%, the methodology and the strategy and the commitment to top tier managers will be the same, whether it's 8% or 5%. So what we're really looking at is, does this strategy make sense? Do we understand how we get from point A to point B with the utilization of this strategy?
You will get through it, I promise.
Okay, thank you.
It's much better that there's
No,
back
it's
and forth
yeah.
than if we
Both
just
questions.
read off the slides.
Yeah, absolutely. And maybe just one moment going back to Dr. Hackbart's question earlier. If you were to decide that 8% isn't right for you from an asset allocation perspective, because of the way private equity funds gradually, we can just pull back that next year on our commitments, and that will help us get to your new asset allocation target. So in the event that there is a change to your asset allocation, it doesn't mean that, oh no, we're going to 8% whether we like it or not in private equity. We can toggle back and make sure that we don't overshoot if you have a new target allocation.
Well,
It seems to me like it's a tool to keep you from overloading in one particular vintage year, depending on your target.
Yeah,
Absolutely, because
Yep,
you could get to,
underloading.
you could make far higher commitments earlier
Mhm.
and get to target sooner.
Yeah.
But the whole point of doing this is not to just jump into the deep end, but to get that vintage year diversification correct as well.
Yeah.
So we touched
Any,
on sorry.
Any other points here that we want to discuss, or is this basically your presentation?
I was going to just touch on kind of two more slides, if that's all right.
Okay, please.
So if you go down one page, so we talked about the pacing. That's the absolute dollar amount that we would recommend committing. This next slide is how we would propose constructing your portfolio from a sector, geography, and vintage year perspective. And so when we take that 600 million in year one, 500, then 400 thereafter, what we would look to do is target 60% of your portfolio to buyout, which is what we would call probably the least risky of the private equity asset or sub sectors. So 60% of your portfolio is in buyout, and then 20% to venture capital and growth equity, and then another 20% to distressed debt and special situations. And we believe that mix is, not only sort of sees the market, it matches the market, but it also leads to a well-diversified, not overly risky portfolio. Then from a geographic perspective, we typically try to maintain a weighting similar to what we see as the private markets opportunity set. And while North America is still going to be, by far the biggest allocation in your portfolio, there is still a large market in both Europe and in Asia. So we would recommend 25% to European managers and another 10% to Asia Pacific managers. And then finally, already touched on vintage year, but fairly diversified, even if we do, we'll call it front load with a little bit greater commitments in earlier years to get you to target quicker, but still well diversified across vintage year, as you can see over the next 4 years. And then lastly, I'll just touch on the next slide quickly. So we have kind of our pacing, which is the absolute dollar amount. We have our construction, which is the targets that we're looking to get to. And now we need kind of a roadmap to get there. And so the next two slides are really your roadmap on how to allocate to private equity managers. And so what we would recommend, and again, the vintage year here on the side, 2025, basically just push that out a year. So 2025 is 2026 and so on. But what we would advise is, in buyout next year, or this year, 2026, 4 commitments to buyout. Next to those kind of top 4 commitments, we've listed basically 8 managers that we have existing relationships with, 2 of which are in market, 4 of which we expect to be in market in the next 2 quarters, and then 2 in the kind of final quarters of the year. These are all groups we know well, have high conviction of, and so just put them on there to kind of give you an idea of the fact that, we believe that you can easily find top tier, top quartile managers on a year-over-year basis that you can allocate to, and we will have the research to help you do that. And then the next slide is, or I guess this is the slide that you're on right now. This is kind of the venture growth roadmap for that piece of the portfolio, and the distressed debt and special situations roadmap for that piece of the portfolio. And we've outlined a handful of names there that we believe are best-in-class managers. As you can see in the distressed debt and special situations category we have SVP listed there. You know that group well. It's a group we have high conviction in as well. So we would say that that's one that you've already made a commitment to. But we just wanted to lay out from a pacing perspective, from what the structure and underlying components of your portfolio we would think they should look like, and then how we get there are those kind of last 3 slides. So happy to take any questions on this.
So if I'm reading your slide you've got up right now, looks like the average investments between 40 and 60 million.
So that's for venture and distress. So if you go to the prior page, your buyout commitments are closer to 90 million. So that being, we feel like you can get a little bit more concentrated in buyout. It's, as I mentioned, a little bit less risky. And we feel like there's typically a little bit less, call it fund risk. In venture, you can have, it's a little bit riskier. And we propose smaller bite sizes in venture and diversifying your target allocation across venture. So we proposed 40 million in venture and growth equity, 90 million in buyout, and roughly 60 in distressed debt and special sits. And that will all, if you make those commitments, that will get you to your targets that are outlined in those pie charts, the prior page.
Any other questions, comments, clarifications?
There's not a cost page.
This is just, so you have the allocation in place already, and you have existing private equity investments, and as John said, you made one, newer one this past year. This is just targeting how much money to put to work. Every one of those funds, when you cover the diligencing of those funds, those costs and everything would be part of that individual investment due diligence.
So
I think make sure I understood what you said, David.
So essentially, these are
the cost associated with each investment is no different than how we've always been doing it. You just do the deal, negotiate the price, and whatever. Your all's service of pointing it in the right direction is all already included in the contract that we have with you all. Correct?
Oh, yeah. There's no cost with us. We're bringing to you our recommendations about how to keep.
I think that's the thing that Bill was wanting to hear.
Yes.
And understand.
Oh yeah, right. Yeah. Nope. Yeah. This is part of our work for you.
Okay.
Yeah.
So how would you anticipate, would there be periodic reports of what investments, how we're matching up with our asset allocation, assuming funds coming from the existing investments and so forth, to provide us some perspective? Is that what the model would basically provide?
Well, one part of that would be in your quarterly reports that you have in place today, where you look at each of your asset classes, the current allocation relative to the policy. You would see this evolve and getting closer to the policy over time in those reports, just in terms of a total asset.
Those would be sort of continuous. Is that sort of the idea? Continuous quarterly
Yep. And there's
updates.
we already prepare for you. Is it quarterly or some quarterly reports? For example, if you go to page 14, just for 1 minute, please. This is a showing of the private equity program, the commitments you have in place, the contributions, the distributions. This is all the way back 20 years or so. We went through some of this at that forum as well. And so we show on here the performance relative to if the same dollars were invested in public markets, how you're doing. And also I would say that ties to recently when we presented and you adopted a change in the benchmarking for private equity. A component of that was to, for every quarterly report, have these performance numbers in there so that it helps you to focus on the performance of your private equity program. So that's really all in place already.
I guess, Anthony, I'd be curious how you would use this.
Hi, Dr. Arkwright. Yeah, this is something that Wilshire's presented. I mean, similar, we haven't had a chance to really look at it in detail because we didn't know that was going to be an agenda item or the materials until they're in the board books. But I think just initial impressions, broadly, it's the similar stuff they've presented for the past 9 years that we don't agree with and have not done, as you can tell. I think if you look at well, we'll discuss it in the investment update part. I think if you look at the asset return assumptions that David referred to, I think that they actually would result in zero private equity allocation. I think for the past several years, including the last time you guys updated your asset allocation. So I think that it's in this latest iteration of real assets and private credit actually have higher expected returns than private equity with lower volatility. So unless you actually constrain the optimizer and put your thumb on the scale, you actually get no private equity allocation. So this is kind of actually what we've been doing the past few years. So as you can tell, a lot more activity in those areas. And the one commitment to SVP last year, which was our first one in 4 years. So I think that this is kind of the old model in terms of strategic asset allocation. I think that maybe Wilshire could talk a little bit about what they've been recommending for CalPERS and some other institutions. I think total portfolio approach has been in the news somewhat. I think that I saw that in November you guys were pretty positive on that, and so that completely does not follow this at all. So that's what I would say, Dr. Clark.
Thank you.
It allows for more opportunistic approaches. We aren't really bucket fillers here, so I think that your question about whether the 8% target is the right one is definitely the question, especially for at the committee and board level, since that's what drives a large part of our returns here. And so that I think having this fulsome discussion on that is super important and really helpful. But yes, I think that's definitely the way things are going. I'll just read what Wilshire said. I think total portfolio delegates portfolio construction authority that was historically handled through strategic asset allocation decisions to staff. This allows a more opportunistic approach in investment underwriting, and it establishes clear accountability for all active investment decisions that deviate from the reference portfolio. Wilshire is comfortable that the board retains the authority to set the overall market risk for the portfolio, as well as a limit on the amount of active risk taking. In tandem, the board will continue to oversee the total portfolio risk profile while delegating specific investment decision making to the investment office. So that's what they recommend to some other clients. This, I would say, is outdated bucket filling approach. I'm not sure why that's recommended for us, but obviously you can tell we have not done that for the past 9 years. So,
okay, good.
Dr. Hack.
All right.
Dr.
Yes,
Hubbard,
go ahead.
provide just a couple of sentence response to that from the Wilshire perspective.
Any other comments, suggestions, or we can move on to the next item on the agenda, I think.
Dr.
Thank you
Hapmark,
very much. Yes, but yes.
this is David. I just wanted to provide a little bit of color on the strategic allocation issue that Anthony was talking about. Is that okay?
Sure, absolutely.
So right, Anthony, the materials Anthony read about CalPERS, yes, the issue that was raised there was strategic asset allocation versus total portfolio approach, which is a much higher level concept to process. And just like your strategic asset allocation is a high level board decision, whether you want to stay with that SAA approach or adopt the TPA approach, that's an even higher level board decision that we'd be happy to walk through at any point. But at this point, you're operating under a strategic asset allocation from a board policy standpoint. So that's all. Absolutely.
But did you prepare some materials to discuss that with this board or our other board, or no? Has that happened yet?
We have not prepared materials.
Okay. Just, you're providing education on that. On this, I think the board asked for things that are current in the market and things that are happening, and so maybe that would be something. Especially, I figure what's good enough for CalPERS is probably good enough for us, right?
Well, it's very client specific, but we're happy to present it at any time.
That's great.
Specific to CERS, though, the moves you've made in recent years suggest that you want a higher level of oversight over your assets and not a lower level.
Correct.
So at that very high level, that would suggest that that wouldn't be a path you'd want to go down, but we're, like David said, we're happy to go into more detail about it, but it does involve handing over a lot of control, and that runs counter to the way CRS has been moving the last few years. So.
Does that conclude our conversation? Any other comments? If not, let's move on to the next item, and that's the quarterly report from the investment staff. Who's going to be the leader on that?
Sure. That's me again. So.
Okay, all right.
Thanks.
Very good. Thank you.
Thanks, Dr.
Okay.
Bart. Yeah, we don't have any managers to present today, so this is mainly just an update on how things went through the end of calendar 2025. We're almost 2 months into the year, so I think we can just go over the market and economic section pretty quickly. And then we'll have Joe, Brian, and I will review and give some detail on some of the different asset classes. And after that, we're happy to take any questions. Obviously, 2025 was a pretty strong year in the market. Another one, the S&P 500 was up again for the sixth time in 7 years. It was up 18% around there. We have credit spreads at all-time tights, but we are getting some yield since the rates aren't zero anymore. We can turn to page 44 now, please. So here, this is what we were just talking about. These are Wilshire's latest 10-year return assumptions for the various asset classes. A lot of areas in the market are pretty fully priced compared to their history. So that's compressed a lot of these numbers. As we return, we kind of take them more directionally than literally. Obviously a lot of things can change in 10 years, but this is a decent guess that they update every quarter. So you can see here, core bonds are expected to return more than U.S. stocks. You can debate that as you will, but that is their most recent numbers. I think it's interesting, again, to contrast this with what we just heard about implementing, additional private equity in the tune of hundreds of millions a year and 9 managers or so. I think with this numbers, again, you would have no private equity if it was not constrained, because you can see an expected return of 6.3, which is surpassed by private credit, real assets. It's pretty close on some of the other areas, but obviously the higher volatility that's involved in, or higher risk, which is calculated as volatility, but that's not really risk. But there is higher volatility given the leverage and the liquidity would make an allocation to private equity easier under this model. So, and on the other hand, private credit, real assets, they have, in addition to their high expected return, now have less expected volatility. So it's not a total coincidence, like we were saying. That's where we've been been active the past few years, adding real assets and private credit. And yeah, we did no PE commitments for 4 years until we added to an existing manager, strategic value partners last year. So basically, the takeaway I would have from this is that there's not a lot of reason to really stretch risk-wise, especially with some of our plans being underfunded. And the targets that we're trying to meet, which is 6.5%. So, so that is what we take into consideration, for our members. That plus the liquidity that we need, since obviously paying beneficiaries is another important thing that we have to be mindful of as well. Go to all right, we can go to page 59 next, please. Thank you. Yeah, so like we were saying, it was another strong year in public markets, U.S. public markets, the S&P 500, Wilshire 5,000, they're both up almost 20%. You can see every sector was up for the year. The concentration is large, like you might know, NVIDIA and Google were almost a third of the return just by themselves. The top 7 stocks made up over half the return. So, I mean, a lot of this sounds the same as the past several years, right? Large beats small, growth beats value. But if you can turn to page 64 now, please. We've been a bit overweight non-U.S. versus U.S., which has not helped over time, but finally that told us started to pay off somewhat. The ACWI ex-U.S. and the EM indexes both almost doubled the return of the S&P. And so, you go to the next page, please. Fixed income also had a good year. A lot of these areas would have met our return targets. And then page 68, please. Just taking treasury risk. I mean, that gets us a long way to our assumed rate of return with 10 years in the 3 to 4 range rather than 1 to 2 like it was the first 5 or 6 years I was here. So we can turn to page 81 now, please, Sherry. Thanks. This is for plan performance for the first half of the fiscal year. All of the C plans are up over 6%. It's pretty close to their benchmarks. The areas that have been driven their performance have been real returns, especially credit, and an overweight to public equity. And so I'm going to pass it on to Joe now, who will have some comments on public equity and what's been active there.
Thank you, Anthony, and apologize. I'm a little under the weather, so sorry if I'm not coming through very clear. I'll try to keep it relatively brief, but happy to discuss whatever. If we'll go to page 84, real quick on U.S. markets, fourth quarter was a continuation of the risk-on environment that we've seen for quite some time now. The quarter itself ended up modestly higher. We'll call it roughly 2.5%. As Anthony spoke to you earlier, large beat small. There was a little bit of a difference in the style leadership. In the fourth quarter, value actually outperformed growth, which was a change from the last several years. And what drove the market really was kind of the higher beta, lower quality stocks. We as a staff are cautiously constructive on the market. Fundamentals are relatively healthy. There is, some decent amount of volatility out there. Valuations are elevated, so that gives us a little bit of pause for concern, but overall, relatively constructive. Where we sit today, for the markets to continue their upward trend, we think that's going to be driven primarily through earnings. Valuations don't really support the idea of a lot of multiple expansion at this point. The market has been very narrow. Anthony kind of mentioned those U.S. large cap and even specific callouts, the Mag 7, how much drove that market. That's been the case for some time, though some of their earnings, while they're still impressive, are starting to decelerate. And some of the, we'll call it the other 493 names in the S&P 5, their earnings are starting to ramp up a little bit, even more so in the smaller cap. So we think that's pointing towards a broadening of the market, which would be good for our portfolio because we are pretty diversified. So it's been this narrow market environment's been tough for us. I guess if you go to slide 85 at this point, Sherry, talking non-U.S. markets specifically, it was a strong quarter. The developed markets outpaced the U.S. large caps almost by a factor of 2x. There is a nice valuation discount in the U.S. or excuse me, in the non-U.S. markets versus the U.S. You kind of see that how that's grown there in that bottom right chart. That's primarily why we've been overweight for some time, the non-U.S. markets, and it actually finally paid out for us in 2025, which we were happy to see. Value has been outpacing growth for quite some time on the non-U.S. side, so kind of a reversal of what we've seen in the U.S. markets. From a macroeconomic perspective, still remains relatively volatile. Inflation is stickier over there, still elevated, but the central banks seem to be accommodative. Those markets for the last, really since COVID, have faced a similar issue that the U.S. side is, just the narrowness of the market. It's been a difficult environment for active management. And then again, lower quality has continued to kind of lead the way over in the non-U.S. Markets as well. Yes, if we'll go to slide 86.
Just a quick question, if I could, Joe. Any reason why the internationals are outdoing large cap?
I think there's a lot of it has to do with, if you look at their underperformance for the last several years, it's kind of one of those where the spring has been wound so tight it eventually is let loose. The valuation concern, they're at about we'll call it probably a 30 to 40% discount from a valuation perspective. So they've become much more attractive recently, and so I think you're seeing some capital starting to cycle into those areas. If you were to look at about a 30-year window, the U.S. and non-U.S. from a frequency and a percent of return have been about the same over those calendar years. But in the last 10 years, the U.S. has really dominated, and I think it's just a resurgence to where non-U.S. is starting to get a little bit of people are starting to look at them a little more, given the volatility in the U.S., where valuations are, and finding some deals over in the non-U.S. marketplace at the moment. So hopefully that, like I said, in 2025, that was to our benefit. Hopefully that will continue. But I don't know if that answered your question sufficiently.
No, it's helpful. There's nothing particular unique reason, I guess. So I was looking for that. And
well, the non-U.S. space has been very narrative driven. So just like the U.S., so AI is starting to what we saw in the AI market as far as what drove our markets for a while. You're starting to see that bleed into the non-U.S. Defense spending really has ramped up with the Russia-Ukraine stuff. So you're seeing some movement there as well. So that may be part of it, some dollars flowing into the markets. Sherry, if you'll go, like I said, 86, 87. 86 is kind of a quarterly. I'm sorry?
I agree with everything you said with regard to the foreign markets. I would like to hear yours and Wilshire's perspective. I've asked this question before because I do think it's a component of it, and that's the currency fluctuation associated with the weaker dollar.
In theory, a weaker dollar is good for us as far as from a return perspective. By the way, it gets translated back into our base currency. Outside of that, we don't hedge anything on the dollar. That's part of our return profile. And so
I'm not asking about hedging. I'm just talking about when you're investing in Europe in the euro, and then you turn around and value it back to a weaker dollar. There's the dollar is down 3 to 5% against the euro over the last year.
Pretty significantly, yes, and that does translate to better returns on our non-U.S. portfolio.
Yeah.
I don't know if Wilshire wants to.
I'll just add, the same comments you made. You're not hedging that currency, so that currency return, whatever it is part of your total return. That's something that, while the dollar was so strong for some period of time, that hurt the performance relative to your U.S. equities, and it's working in the opposite direction right now. So we view that as part of the diversification of investing in the non-U.S. markets. And in general, over the very long term, we think there is purchasing power parity that will play out, meaning currencies will generally long-term deliver the same returns, but they're very cyclical, and you have periods of ups and downs, and so it's just a good part of the diversification story.
Right. From a performance standpoint, this comment's pretty much the same for the fourth quarter as it is for all of 2025, and this was just a period that was marked by a persistent risk-on environment. Better than expected earnings drove some of that. We saw some improving growth in the market that wasn't necessarily expected. Rate cuts, the conversation about that throughout the year kind of would be a lift all boats kind of thing. And so really what we saw was this low quality headwind across our portfolio, regardless of the style, regardless of the region we were invested in. It was just a difficult environment from an active perspective. The correlation between true earnings of a company and their performance of their individual stock, that correlation seemed to weaken throughout the year. And so just a difficult time for active managers. In fact, about 80% of all active managers have underperformed their respective indices over both the 3 and the 5 year period at this point. And so I was reading something that kind of made an interesting statement. And it's, I believe, true, at least in this limited short term, and it was diversification is forcing relative underperformance. You heard Anthony make the comment, essentially 7 names drove 50% of the performance of the S&P 500. Well, when we put guidelines on a manager that say we want, to diversify our strategy, we don't want all eggs in one basket, they can't own 50% of that strategy in those 7 names. And so it's very difficult to keep up in that kind of environment. So long-term diversification is a great investment principle. Short-term 2025, it's been a headwind and a difficulty for us. And that was persistent throughout the portfolio.
And Joe, if I could add, that's a common issue for asset owners right now. So it's not just your portfolio. This is a challenge all over the place.
Right. As far as our individual performance, fourth quarter, we underperformed. At the U.S. level, we performed in line. Allocation had little impact. Stock selection was split amongst our managers. From a non-U.S. perspective, absolute return of over 4%, though we did underperform, really coming from the developed growth portfolio. This was partially offset by our deep value mandate and our emerging market mandates. And then, I'm struggling. For 2025, strong absolute performance of 21.5% return, slightly below that of the benchmark. Individual strategy performance was probably weaker due to these factor headwinds we've talked about from a low quality perspective, particularly our tilt towards the non-U.S. We've discussed that. It actually offset a lot of that weakness. And so that was able to keep us relatively even with the benchmark. At the U.S. equity portfolio, our active managers struggled, and the internal portfolios, luckily, they were able to outperform. We had a modest tilt towards value early in 2025. That was a headwind for us. We remain a little bit smaller. Today, we think as the market broadens out, that's going to be a benefit for the portfolio. From a non-U.S. portfolio perspective, weakness across pretty much the entire portfolio for the most part, especially anything that had any kind of growth bent to it. Our deep value mandate did well. Our emerging markets mandates did well. And so that partially offset some of that weakness. And then if you'll, Sherry, go to page 88, I believe. See if I can regain my voice a little bit. This is something that Steve wanted to talk about, adding to our quarterly updates, and that was some individual strategy information. We've not done that for a while. We had a few positives in the portfolio, but really the highest nails, unfortunately, were a couple managers who struggled and have been struggling. So just to give you a little color on that, both of these are international developed growth managers. You've heard me mention that they've struggled. The value rotation that took place in 2021 is pretty sharp, and it really caught a lot of growth managers, caused them some issues. Value has outperformed growth by an annualized 9% over the last 5 years. And so as you look at these managers, I need to point out, we mark them, even though they're a growth manager, to a core index because they were brought on as a basket of developed managers who were all being benchmarked to the core, whether they were growth or value. That's how we did it since they came to the portfolio. I'm not advocating to change that at all, but just pointing out that there's some biasness as far as the style perspective when we look at these. So if you look at the 5-year number for American Century, it shows underperformance of 6% annualized. That 9% range between value and growth, if you were to cut that in the middle at the core, roughly 4.5% of that 6% underperformance is based on them being a growth manager in a very value driven market. So while they look ugly versus a core, it's not as bad when you put them against, when you think of them in the context of they're a growth manager. That being said, they're not without fault. They had some issues. So primarily they held on to their winners for way too long. PE multiples got high. Growth managers tend to pay up for perceived growth. They probably should have taken profit much earlier than they did. So while they didn't necessarily lose absolute dollars on those investments, they lost relative dollars in terms of opportunity cost, if you think of it that from that perspective. The premium that people were willing to pay for growth collapsed. So those multiples around those investments collapsed. Exogenous events seem to happen way more frequently. This is a bottom-up fundamental manager. They probably did not do a good enough job from a scenario analysis perspective, and meaning you can buy a really nice home. If it's in a bad neighborhood, it's probably not going to appreciate. And so they're not going to become a thematic investor. They're not going to become a top-down investor, but they realize they've got to do a better job from a scenario analysis as they look at those investments. I continue to have confidence in the strategy. I like the team. I like the philosophy behind them. I think they've taken corrective, some ownership in some of their missteps, and they've taken some steps to try to correct those to the extent they can. Ultimately, we need a more agreeable market that actually is interested in growth. I think if that comes along, you'll see a much different performance from this manager. But we're just letting you know that we're aware there's some issues in the portfolio. We're having conversations. We're assessing, do we want to continue the relationship or not? At this time, I still have confidence in this strategy. I think this has just been an ugly period, to be honest. One more to talk about, if you'll go to page 89, Sherry. This is Franklin Templeton. This is, if you were to rewind the clock 4 years, this was our best performing strategy in the entire portfolio. They are an incredibly concentrated, aggressive growth portfolio. And so they suffered from the same value headwind that American Century did, except they did it I don't want to say levered, but they're extremely sensitive to style perspective. So when growth is doing well, they're doing extremely well. When growth is doing bad, they do extremely bad. Unfortunately, two of their worst years in the product's history happened to fall in 22 and 25, which happens, to be here recently. So not only did they suffer from that value headwind, but they're also smaller cap, so they're more of a mid cap opposed to a large cap developed manager. Mid cap, smaller caps have underperformed in the non-US space. The narrowness of the market really hurt this product, and so we've mentioned some quality headwinds as well. That's been an issue as well. So you see on that bottom right some of those cumulative headwinds over the last year, what that's done. It's kind of a multiple factors that could go wrong, all happening at the same time for this product. That being said, they've, again, not without their own missteps. They had an analyst in the healthcare sector in 2024 that had a rough go at it from a stock picking perspective, gave up about 9% from that one sector. They're no longer employed there. They have a new analyst that I've met with, talked to several times. He's turned over that portfolio, consolidated the ideas. In 2025, it was actually accretive. So it looks like this was a good move by the team. They have always had a 20% relative stop loss attached to any security, but the underwriting was probably not would be considered not aggressive enough. It's gotten much more aggressive with the bent of this idea has got to go unless there's just significant evidence of why it should remain in the portfolio. From a risk budgeting perspective, you heard me mention it's a very concentrated, aggressive growth portfolio. In the past, individual stock contributions, the tracking error was allowed to really ramp up. They've now put in a 6% limit to that. The idea is they want it to be meaningful enough to be additive to the portfolio. And when you take all these ideas and they're economically diverse, then that can still participate in up markets significantly. But the idea is if there is a misstep that one or two names can't derail the performance of the entire portfolio like they have had some issues recently. The idea generation of the analysts is being incentivized for quicker response to being able to come up with ideas for stale capital. Ultimately, I guess one other thing you've heard me kind of mention before, we did renegotiate the fees with these people back and made that retroactive at the beginning of the fiscal year. So we currently are paying 0 management fees, and we will not be for some time. That does not mean that we're going to be sticky and stay forever. It's just a little bit of a make things feel a little better as we work through this. I think the team itself has done all the corrective actions that they really can do at this point. As far as the areas they have control over, the market they do not have control over, and those factor headwinds persist. And so this is one that's a difficult call for us, and we're going to be looking at it closely at whether we want to continue the relationship or not. But I wanted to be upfront with you as to the issues with this portfolio. I guess the nice thing I would stress is this is a member of 4 basket allocation to developed markets. This is the smallest of that basket at about 16% of that allocation. So still meaningful, but it's not our largest position, so that's good. And now that I've told you a lot of negative things, I will give you one green positive is we renegotiated 7 of our 14 active management fee contracts in the 4th quarter. We strive to make sure that we're paying in the cheapest quartile for active management. After renegotiating now, 12 out of the 14 are there. One of them is sitting right on that edge, and one is in the cheaper half, but it is moving towards where we want it to be through those negotiations. We project annualized savings of over $4.5 million. That includes the Franklin Templeton, which obviously is an extreme case at the moment. If I exclude that, ongoing relationships with the 6 other ones that we renegotiated, annual savings of about $2.5 million, which equates to roughly 12.5% discount versus what we have been paying for those for that management. So that's an ongoing year-over-year savings. So that's one positive I can report to you from the quarter. Maybe I hope to have better high nails next time I come in front of you. So, but happy to hear any questions or comments.
Thank you. Any questions? If not, thank you for your report and update. Appreciate that very much.
Yeah. Thanks, Joe. Yeah, that's some good detail on, and the work that he does on, all of our active managers, right? That we can get risk cheaply. So if we're going to be involved with folks, we want them to be able to provide something different, and obviously we're pretty vigilant about that. So we go next to Brian. We'll talk a little about fixed income and credit.
Thanks, Anthony. I'll start on page 90, please. Thank you. The yield curve steepened over the final 2 months of the year as the Federal Reserve announced 2 more rate cuts. Yields seesawed over the quarter, with the 2-year falling at roughly the same rate as the 30-year rose, with the belly of the curve effectively unchanged. The 2-10 Treasury spread widened into year-end and finished the quarter at 69 basis points, up from roughly 54 basis points at the end of last quarter. Next page, please. Thank you. The core fixed income portfolio generated just over 1% for the quarter and 3.24% fiscal year to date. The top 3 performing sectors for the quarter were MBS, CMBS, and ABS, generating 69, 17, and 16 basis points of excess returns, respectively. Investment grade credit spreads widened 4 basis points for the quarter, finishing 2025 with an option adjusted spread of 78. Next page, please. Thank you. The specialty credit portfolio earned just over 2% for the quarter and 4.64% fiscal year to date, outperforming the custom benchmark for both time periods. Returns by quality were mixed over the quarter, with lower quality issuers underperforming, with double B, single B, and triple C rated issues returning 152, 157, and 14 basis points respectively. There were 10 rising stars for the quarter against 1 fallen angel. Despite the imbalance, 2025 fallen angels outpaced rising stars by 11 billion. Page 93. High yield spreads only tightened 1 basis point during the quarter to an option adjusted spread of 266. However, for calendar year 2025, spreads tightened 21 basis points, ending the year at the tightest level ever. The high yield market delivered its 3rd consecutive year of over 8% total returns in 2025. While the quarter's return was more muted and spread volatility increased, overall spreads continued to trend lower as the view on macro and fundamental backdrops remained positive for corporate credit. And next page, please. Liquidity. The Federal Reserve delivered a 3rd consecutive rate cut for 2025 at their December meeting, though it may have been the last for this round of cuts. The FOMC statement said the committee would consider the extent and timing of future rate cuts, language they have previously used to signal a pause. Chair Powell reiterated that policymakers felt well positioned to wait and see how the economy evolves. Despite signaling a pause at the next meeting, the Fed clearly maintained an easing bias, as Chair Powell sounded very dovish on the labor market. The Fed dot plot has expectations of only 125 basis point cut in 2026. However, short rate markets are pricing in 2 cuts for 2026, with the first happening mid-year. For the quarter, performance matched the benchmark, returning just over 1%, and the fiscal year to date return was a little over 2%. And I'll turn it back to Anthony to talk about real estate, real return, and private equity.
Brian, we go to the next page, please. This is just private markets overall. Like it's been for several quarters now. It's up, but just not as much as the stock markets. And then you go to the next page, please. This is for real estate. The decline in values has slowed a little bit. This red circled group of orange bars is the negative appreciation that's been seen in real estate for the past several quarters. It's finally starting to slow down or even turn a little bit slightly positive. So that's helped with returns. It was not an amazing year in this area. Mostly of our exposure is in our core funds, and those provided income returns around the 4 to 6% range, and kind of flat to slightly down appreciation. So that's what they were able to produce. But I think the good news is, for the most part, they've cleared their redemption queues. They actually have commitment queues right now, waiting to be deployed, and are starting to be active in putting the money to work. So that's good. And then the next page, please, Sherry. This is on real assets. Again, it continues to be attractive, especially if inflation continues to be higher than the Fed and other people's beliefs, like it has been for the past 5 years. I think our managers in the space have continued to call capital and find attractive things to do. So we've had calls and deals in energy, transportation. Our barge leasing group did a few acquisitions last year. So our farmland deployment was called, including additional capital. So it continues to be an attractive area, and also less correlated with other parts of the market. Next page, please. This is private equity. It's still a logjam. So yet again, another reason that things are not so great. I think you've seen in our portfolio, things have just continued to linger all around. The Bain annual private equity report came out yesterday. They have over 30,000 private equity companies, representing almost $4 trillion of value still outstanding. And average hold periods for companies are getting close to 7 years now. So on a term that was originally 10 years, obviously you've seen many extension requests. So those funds just continue to go on and on. So, all right, Sherry, could please go to page 108. This is our performance against peers. Some of Steve's favorite charts, and we like them too. I think what you see here, you can point to the 5-year returns. We've topped decile returns and Sharpe ratios over the past 5 years for all C plans. So that's, I think, better than 90% of the comparison set here for both absolute and risk-adjusted returns. We go to page 112, please. And here you can see this says just returns, not the volatility, but you can see the C plans are top quartile against peers over the past 10 years as well. So I'm happy to take any questions here. Otherwise, yeah.
Any questions of Anthony? So is that your report?
That's our report, Dr. Akbar. Yep.
Are you also going to cover the investment budget update? Or
Indeed, I am.
Okay.
Yes.
You're still on board. Let's move ahead.
Thank you.
Okay. Thank you. Thank you.
Sure.
Update on the investments.
Here you go. Yeah, this is. I believe this was already presented at the Finance Committee last week. I understand there's some questions, so I think we may go through a couple of those. I think Solovis and Alborn were both engaged back in 2021 after the CERS was created and the split, and that was utilizing the procurement policy that was in place at the time. So it's kind of like other sophisticated plans that we talked about, delegates authority to the chief investment officer to procure things that are used to do the job day to day. So rather than being maybe focused on by folks at the strategic level. So I think in terms of what they actually do, there may have been some confusion. Solovis, one is an investment consultant, and one does reporting and analytics for us. Alborn is a consultant. I think this is something that we felt we needed because we want some additional to what we're receiving from OSHA. We use this for sourcing and then ongoing due diligence for managers on a daily basis. For alternatives, they cover quite a bit more than OSHA does, significant breadth. They also do their own operational due diligence, which we've utilized for any managers that we've recommended to you all. They also have a lot of manager and sector-specific research, daily industry notes, weekly CIS email. Their database is also very searchable, including by date, which I've asked for OSHA for years, and I think even after almost 10 years, that functionality still does not exist. The last time I checked. So, as for Solovis, the idea for that is it is supposed to help us with research management and reporting and analytics, and so that's something. See here.
Any questions of Anthony?
Oh no, hold on. Sorry. Yeah.
One more. Okay.
Yeah, I'm just talking about Solovis. I was going to say about a couple of things that it does. Sorry, I'm trying to find something I need to talk about here. But yeah, sorry. It has. Yeah. Okay. So I think I'll have Carrie and Ian talk about some of the functionalities they have. The research management system I know Carrie has used to clean up some of the findings that internal auditors had. So I'll have her speak to that, and then Ian can talk about some of the analytics and capabilities that Solovis has as well. So Carrie, do you mind talking about that?
Just very briefly, we do use the research management system component that's packaged with Solovis for investment document repository rather. And that's come up in a couple of internal audits, so we have corrected that using the research management system.
Yeah, and then I'll just touch on Solovis. Like Anthony said, it's basically a multi-asset portfolio management, analytics, and reporting tool for institutional investors. It used to be owned by Nasdaq, but they ended up selling it to Insight Partners, which is a global software PE firm. I think that transaction's expected to close in the first quarter of this year. Its capabilities include performance measurement across all asset classes, and it serves as an independent verifier of performance from BNY, as well as supporting the audit of the gainer calculation. It provides look-through exposure analysis. It's capable of modeling portfolio liquidity and projecting cash flows. And then, lastly, it offers reporting and interactive dashboards, integrates with Excel, provides an API for programmatic access to our data. And then I'll just also add that in the spirit of, one of our core values of continuous improvement, since I've joined, I've been actively reviewing our technology platforms and evaluating whether they remain the best fit for our needs. And so far, I've been focused on getting up to speed on each of our systems, including its functions, dependencies, role in our workflow, researching alternative solution providers and their capabilities, and then surveying investment staff to just gather feedback on our current systems, gaps, and any potential needs.
Thanks a lot, Ian. So if anyone does anyone have any questions, we're happy to answer them about either of these areas and things we've used them for, or what we're showing out for, or anything like that. Happy to talk about it. So,
any questions of Anthony?
Yeah, I've got questions. I want to
please go ahead.
Confirm. You indicated that these were procured in 2021 under the old procurement policy. My understanding, apparently that procurement policy did not have a component that indicated that those procurements were ever to be disclosed or discussed with either of the boards of trustees or the board of directors of KPPA until they were completed. Is that correct?
That I couldn't really speak to.
Second question,
I think that there was, all I've seen is memos, I think, that would talk to the executive director who said that it was approved.
$1,000, and now we're spending over $370,000, and we've not seen anything to discuss why those costs have exploded.
Sure. I'm happy to talk to those. I think if you look at the contract details, it was originally contracted for $245,000 a year with a 5% escalator. So just with that, given the time that's passed, would be about $298,000 current. So I agree that's a large number percentage-wise. And then I think after there was a change in CIO, I think it was determined that the data feeds from the customer that was covered on the existing agreement wasn't able to produce some of the things that we wanted in terms of performance analytics and performance calculations, like the gainer, like Ian referred to. So there was an amended agreement done back then in 23 that expanded the detail for the portfolio. The additional cost was around $50,000 a year, and then that was offset partially by eliminating some overage charges. So they were charging by the line item. So every time we added a new investment, they counted that as 12 new accounts. So you have the 10 plans, underlying plans, and you have pension and insurance, right? So it charges for 12 line items. So when you charge by that, then obviously the things increase as we add new investments. So the new third-party data load, I guess is what they called it, was offset. That additional charge was partially offset by the reducing the line item overages. So, and then the $50,000 also has a 5% escalator. So in total, that's kind of what's brought it up over the years. It hasn't been it's just been kind of changes as some of the capabilities were looked at. And so, yeah, does that make sense, or to the question?
Calculate the gainer prior to contracting with these firms, number one, and were these addition, or did we get rid of whatever we had prior to that? And then secondly, indicated that there's been changes to the contract. Have they not been brought to either of the boards of trustees or board of directors?
I wasn't involved with that, so it's hard to say, but I don't think that usually vendor contracts at this level are brought to board levels. But I mean, hopefully there's different policies and stuff in place now, but 4 to 5 years ago, things were not the same.
Dr. Hackbart, you are muted.
Sorry about that. Thank you, Anthony, for your report. We have one other item on our agenda, and that's the compliance report by Carrie. Do you have a report to present?
Yes, Sherry, I'm just going to summarize these few slides so we can get through it quickly. But in your material, you have a quarterly investment compliance report for 2 quarters. One of those is the quarter ending September 30th, 2025, and the other is the quarter ending December 31st, 2025. We've got one to make up that was that we pushed off from the last regular investment committee meeting, and there are no exceptions to report in terms of investment policy guidelines or in terms of asset allocation, deviations from outside of the range, and the proxy reports are online and available as required by statute.
Okay, thank you. We're getting dangerously close to going over 2 hours, so with any other comments or questions, I will take a motion to conclude our meeting.
So moved.
Second.
Is there a second, please?
Second.
Motion carries. We should have a vote. All those in favor say aye.
Aye.
Motion carries. And we did make it exactly 30 seconds until 2 hours, Mr. Chairman. So I think we